Welcome back. We are now in segment 8.9, and in this segment we'll be discussing about drawing power. So far we have seen the assessment methods, that is prior to the sanction. Okay, so once the limit is sanctioned, we enter into the real world of disbursement. See, assessment is one part of working capital episode. It is based on the CMA data, the projections which the company submits, right? So we already seen. So a company comes for renewal. If 2013 is the latest financials available to us, the bank will be taking the projections for the next 2 years, and based on the CMA data, CMA projections of these 2 years, it will be sanctioning a limit. So in this CMA data is basically projections, isn't it? So a bank, say the company has a turnover of 80 lakhs in 2013 and is projecting a turnover, say 110 lakhs in 2014, 130 lakhs in 2015. So based on the projected turnover, it is sanctioning some limit, CC limit. So this is the assessment part. Okay, this is basically theoretical because these are basically projections. The company has not yet achieved them. So based on the promise of the company, based on the track record and many other factors, the limit is fixed. Now when it comes to this is the sanction part. So a limit of say a limit of 80 lakhs is sanction. This is the sanction limit. Now when it comes to the actual drawal, right, once the documentation is completed and the drawings are to be allowed in the CC account, banks do not allow the entire 80 lakhs. And this is the point you have to remember. Drawing power means the bank will be placing a restriction on the amount the company can draw. See, this is a sanction limit. This is the sanction limit as per the sanction letter. But as on the date of the drawal, on the date of the actual disbursement, right, when the company wants to draw some amount out of the CC account, banks will be calculating what is known as DP. Okay, they'll be calculating drawing power. We'll see what drawing power is. So the drawing is restricted to drawing power. So the working capital disbursement, when it comes to the actual drawal, it will be restricted to the drawing power. So banks will ask the company to submit what is known as stock statement. Okay, from the stock statement, DP is calculated. We'll see the calculation. Okay, so but basically this is the method, right? Banks will not allow the entire sanction limit. Sanction limit is totally different, right? You can have a sanction limit of 100 lakhs, but that is immaterial. When it comes to actual drawal, on the date of the, if you want to draw from this limit, banks will be asking company to submit stock statement. Not every day, right? There will be some periodicity. Mostly it will be monthly stock statement, right? Monthly stock statement, and based on the stock statement, banks will be arriving at what is known as the DP, right? So say for example, the DP is arrived at only say 85 lakhs. Banks in that case will not allow the entire 100 lakhs. They will restrict the drawal to only 85 lakhs because the DP available is only 85 lakhs. We'll see the calculation how DP is done, but this is the point. Okay, so it's immaterial how much limit you have on the day of the actual drawal. If your DP is only 85, banks will be restricting the drawing of the company to only 85 lakhs. If the DP is 90, they'll allow to 90. If it is 95, they'll allow 95. If it is more than 100, say if it is 100, they'll allow 100. If it is more than 100, say 110, of course. So they will in that case they'll be allowing only the sanction limit 100. Okay, so you might have understood what banks are trying to do. So the actual drawings in CC account will be restricted to one of these two, right? The sanction limit and to DP, right? Whichever is lower. So this is how banks allow drawings in the CC account. So if the CC limit if the CC limit is 100 lakhs, right? If the DP is 100, they'll allow the complete draw. They'll allow the company to draw the entire limit. However, if the DP is only if the DP is less than the sanction limit, they will allow only up to the DP allowed. If it is more than if it is more than the sanction limit like 110, they will restrict to 100. Okay, so whichever is lower, sanction limit or DP, whichever is lower. So in case you're wondering why banks do that, when they themselves have sanctioned a limit of 100 lakhs, right? Why are they restricting to a lower amount? So the logic here is banks want to secure their advance, right? Banks want to secure their advances. So they want this the OCC outstanding, right, to be backed by tangible security. So in case something goes wrong, they want to sell the security and recover the outstanding. Okay, so basically it is related to security, right? Basically, why they restrict to DP is basically they want to have security. They want the limit, the outstanding, to be backed by sufficient security. So coming to the calculation, this is what banks do. So for each item of security, so what is each item? Each item in the sense that we are speaking of CC limit. So obviously we are speaking of current assets. So current assets, as you know, includes inventory, debtors, major portion. In inventory, of course, you have all the raw material, stores and spares, work in progress, and finished goods. This we are aware of, right? So from the current assets, each and every item they'll be deducting some margin. Now this margin is stipulated by the bank. Okay. So how much margin that is stipulated by bank for each individual item. So they'll be deducting the margin, and the balance they'll be allowing at the bank finance, right? So say for example, if the say as per the bank's policy, the raw material margin is fixed at 25%. So if the stock of raw material is 200 lakhs in the godown on the date of the drawal, if the raw material stock is 200, what banks do? They will deduct 25%. They will not sanction 25%. Okay, so 25% is the margin, and the balance 75 only they will be sanctioned. That is 150 lakhs, right? So they will allow 150. They will allow the company to draw up to 150 lakhs against the raw material stock. Similarly, for each asset there will be a margin, separate margin. For work in progress, finished goods, there will be a separate margin. So how these margins are fixed? Again, these vary from bank to bank. But if you want a broad reasoning behind the fixation of the margin, it's basically about the ease, right? The ease of sale, or in other words, you can say the risk. Okay. So some items are risky in the sense that, say for example, if you compare raw material versus work in progress. So which of these do you think is more risky? So to answer this question, you have to put yourself in the shoes of the banker. Now, say for example, this company has gone bad, right? This loan has gone bad. The CC limit outstanding, say it's 100 lakhs. Now that this company has gone broke and the company is not paying, right? You want to recover the advance. So as a banker, if you are in that situation, right? So how are you going to recover the advance, right? So you have at your disposal, right? Because you have sanctioned the CC drawings, allowed the CC drawings based on some drawing power. So you have some security, okay? So you have some raw material, you have some, in the godown you have raw material, work in progress, finished goods and debtors. So you have these items, okay? So now we are imagining the company has gone broke, and we have these assets. How are you going to realize? How comfortable are you? Of these four items, which item do you prefer most? Right, if you want to sell, now you are imagining we are in a situation where the company has gone broke, and we want to recover our outstanding by selling these assets. So which of these four assets do you prefer? So raw material versus work in progress, which one do you prefer? So this is simple, right? Take for example a tailor. Okay, so you have given a cloth to a tailor. It's a cloth of some meters. Right, dimensions. You have given the cloth to a tailor. This cloth is raw material. Okay, now say for example this tailor has started working on it. It is in progress, but it is not yet converted into finished goods. Say for this is a shirt. Okay, this is a final finished product. It is not yet converted. It is in the work in progress. So what it means actually, work in progress for a tailor? This means the cloth is cut maybe as per the measurements, and it is under process. It is not yet converted into shirt, but it is cut into various pieces like this. Right, he has to do the stitching is yet to be done. So when you speak of realizability, if you want to sell this in the market, which of is it the raw cloth that is easy to sell, or this work in progress, these cut pieces which are yet to be stitched? So obviously the raw cloth is easy to sell, because this can be used for multiple purposes. So you can sell it to any person because it is not cut to any particular measurement, whereas this is now in progress. It might suit only one particular person measurements. Okay, and moreover it is already in process. So if you really speak of realizability, this is much better. So raw material is more easy to sell in the case of, we are speaking compared to work in progress. So what banks do is they'll say we will allow more. So against raw material we will allow 75%, up to 75% we will allow raw material, but work in progress maybe we will allow only 60 or maybe 70 or 65, right? So this depends on the bank policy. Each bank will be having their own guidelines. You have to refer your bank's guidelines for this purpose. But the logic is basically this: each item, raw material, work in progress, finished goods, debtors, will be having an individual margin. So bank will be financing the balance portion. Okay, and that margin is fixed based on the risk or the ease of realizability. So sometimes most banks actually have a common margin for raw material, stores and spares, and work in progress, finished goods. So these usually it is 25%, right? Some banks have a higher margin for work in progress. This we discussed because this is more risky. But of all this, maybe raw material and finished goods are comparatively easy to sell. Okay. About debtors. So if you see actual practice in banking, debtors are given more margin. Banks actually feel that debtors are more risky, right? They sanction up to 75%. That is, the margin is only 25% in case of raw material and finished goods. Whereas for debtors, they fix the margin up to 50%. That is, they sanction only 50% of the debtors figure. So say for example, raw material is 100 lakhs, debtors is also 100 lakhs. So when it comes to DP, when it comes to drawing, when it comes to how much bank will allow against this raw material of 100 lakhs, they will extend up to 75 lakhs, right? But whereas up to debtors, against this debtors of 100 lakhs, they'll allow only 50 lakhs. So for the same amount of raw material debtors, they'll allow more for raw material against raw material rather than debtor. So banks, so we discussed why this is so, right? This is based on the risk perception. So banks feel that it is more difficult to realize money from debtors rather than raw material. So this might sound counterintuitive, but you might feel that debtors is the end portion in the cycle, right? In the operating cycle, it starts with raw material, converted into work in progress, finished goods, and you already sold this. Debtors will arise after sale, right? So you already sold this product. All that is left now is just realizing. So since the cycle is almost completed, the entire risk is completed. Just this portion, just recovery is left. So why do banks do not feel that much comfortable lending to debtors? Is the reason is again based on past experience. Okay, so one of the books I have mentioned in the reference at the very beginning of this book, I think I have mentioned a couple of reference books, right? So if you R. Viswanathan's Industrial Finance has got a good discussion on this. So if you want, you can refer that book, R. Viswanathan's Industrial Finance. So in the history of banking, in the Indian banking, primarily recovery has happened through sale of fixed assets. Basically, banks have recovered the bad loans outstanding basically by selling the fixed assets like land, building, machinery, those sort of assets. Very rarely have banks realized dues by selling the current assets, either stock or debtors. Very rarely this has happened. So you have to basically judge this, why this high margin is based on the experience of the bankers. Maybe it was the past experience of bankers that these debtors, when it comes to really winding up of the company, at that stage of a company, maybe these debtors don't exist, or really these are bad debts. These are really debtors which cannot be recovered. Maybe that was their experience, right? We don't know what is the reason, but basically banks do restrict, impose a higher margin on debtors. Okay, so let us take an example. A bank has these margins. Okay, against raw material, say the margin is 25%, work in progress 35%, finished goods 30, receivables is 50, right? So let us assume this is the margins as per a particular bank's policy. Now the actual figures are like this: raw material is 200 lakhs, work in progress 50, finished goods 100, and receivables 250. We now need to calculate the drawing power. Okay, so this is very simple calculation. You take the figure, right? What is the margin? Say for example, raw material is 200, right? So margin is 25%. So bank will be sanctioning the balance 75%. Okay, so 200 into 75%, that works to 150. So for each item, we will calculating the bank finance, and you add up, you'll get 377.5. Okay, so DP was arrived at 377.5. Now suppose the sanction limit is 400 lakhs. What banks do? They restrict the drawing to 377.5 lakhs because DP is less than the sanction limit. So this we already discussed. Drawing is restricted to sanction limit or DP, whichever is lower. Okay, but there are some modifications to this. Okay, there are some modifications to this calculation which you have seen. This is a straightforward calculation, but if you see, each bank will be having a slightly different version of drawing power. One thing banks might do is, so from the raw material, sometimes banks deduct creditors. Okay, so that is something most banks do. Okay, so again, these individual treatments vary from bank to bank. Okay, but paid stock is, but you need to be aware of the term paid stock. Okay, so paid stock is they'll deduct from the raw material, they'll deduct the creditors. So what you arrive at is known as paid stock. Okay, so on that they calculate 25% margin. So in the earlier example, we straight away calculated 75% of 200. So in practice, usually this is done. Okay, they deduct the creditors. Okay, and I'm not saying all banks do that. Some banks in fact do not take this, but some banks do take. In fact, most banks do this. Okay, so 75% on the paid stock, that is after deducting creditors from raw material, and then the rest of the calculation is same. So in this case, we'll arrive at a lower DP, right? So when it comes to DP, there are a few precautions you need to be taking, right? As a credit officer, when it comes to DP, you should be aware of a couple of important things. One is as in when you receive the audited balance sheet of the company, right? You may not receive this balance sheet with the proposal. Okay, so when it comes to a renewal proposal or enhancement, maybe that time you will not receive the audited balance sheet. So say for example, you are in say July. Okay, say July the renewal proposal or enhancement proposal has come. By this time, the March audited balance sheet is not yet ready. So you renewed the limit or enhanced based on the last year audited. Say this is 2013. So based on 2012 audited balance sheet, you have renewed because 13 audit is not yet ready, and maybe you might have taken some provisional financials, tentative figures as on March 13, but these are not unaudited. Okay. So based on this, you sanction the limit. Okay. So what happens is somewhere around in August, September, when you actually get the audited balance sheet, you have to call for this balance sheet March 13, right? So even though you sanction the limit, even though this company will be coming to you only after 1 year for renewal, in July 2014 only they'll be coming to you. But in between, if you get the balance sheet, you have to call for the balance sheet, right? If it is ready, you have to call for the balance sheet. And what you have to do it, you have to calculate, you have to see the inventory and the debtors figures, right? So in the balance sheet order balance sheet, please check these figures in inventory and balance sheets, and you compare these figures with the stock statement. So stock statement is something which companies will be submitting, right? So banks will be asking the company to submit stock statement every month. So what is this stock statement? Stock statement is actually a declaration by the company. This is the statement by the company. Okay, this is not something that banks go to the company, go down and verify. Right? That is done. Right, that is done in the periodic unit inspection. That is done separately. But every month the company will be submitting a statement on its own, declared by its own, declared as true. But this is not something banks verify. Okay, so in the stock statement, what they furnish the quantity, how much tons or whatever it is, whatever the units. Okay, what is the rate? Okay, and what is the value for each item, like raw material, stores and spares. Okay, finished goods. And from those you will take the value. So how did you get these figures? So how did you get these figures? These figures you got from the stock statement, right? Stock statement is the basis for these figures. Okay. So based on this, you are believing and you are sanctioning you are allowing drawings as per the DP. This DP calculation is based on these figures. You are believing these to be true. Now it might be very possible that the company has fabricated these figures. Maybe it has boosted these figures to get the drawing power. So what you have to do, when you get the audited balance sheet, right? You take the March stock statement. In fact, you have to take the April stock statement, okay? Because stock statement is submitted, say for example, usually around 5th or 10th it will be submitted. So the statement which you get on April 5th or 10th is the stock statement for the previous month, okay? Somehow you get that figure, right? Whatever it is, you compare the inventory and receivable figure in the balance sheet of 31st March, right? With the stock statement submitted for March, okay? And then there should not be very wide variation. So if there is wide variation, you have to call for explanation. Okay. So if there is wide variation, it is clear indication that the company is boosting the figures to get more drawing power. Okay. That is one point you need to remember. And also when you go to periodic unit inspections, right? You have something called excise registers. Okay. So if this is a manufacturing company, you have excise registers. There you'll be having the figures for the production details and the production details. So that is one way you can cross check. Okay. One more point you have to remember is stock statement should contain the value of sundry creditors, because earlier we spoke of the concept of paid stock. Okay. So to get paid stock, we deduct the creditors from raw materials. Okay. So sometimes companies submit stock statement without this creditors figures. They'll say they'll list out the raw materials, stores and space, work in progress, finished goods, debtors, okay, and they'll give the value and they'll calculate the DP, but they will ignore this. So by doing this, you'll get a higher DP, right? So if your stock statement, if the company's stock statement doesn't have the creditors figure, you have to advise them to include this creditors at least from the next month, okay? So to get the correct DP, right? Now, I told you that the stock statement contains the quantity details, rate, and the value. So quantity into rate is value. Say for example, it has got some 10 tons of raw material, and the per ton, say for example, it is 10,000. Okay. So the value of this is 1 lakh. Okay. This is the lakh. Okay. This is as per the stock statement. How do you know these two? I mean, declared by the company. So this anyway. So there is a quantity figure and there is a value figure. Quantity figure, okay, that it might be difficult for you to physically inspect the unit, because this is a statement that is submitted monthly. Every month for all the units in your portfolio, in your office branch, you cannot physically go and verify. All right, this might be difficult, but the value is something you can verify, right? You'll have a rough idea. Say for example, based on the product, you'll be having a rough idea. You know the past trend of this particular product of this company. You know what is the prevailing market rate. You can speak to a couple of a couple of other customers in the same industry. As a banker, you'll be having a lot of contacts. Okay, this is not an isolated industry. You have a lot of contacts. You can have a rough idea of what is the unit price prevailing in the market. So if this sometimes the borrowers hike this figure to get more DP. Okay, they say the value is more. So the basic you have to understand is the stock statement. In the stock statement, the valuation should be done at selling price or cost, whichever is lower, right? This is in fact a fundamental principle of valuation, right? Lower of cost or selling price. So the lower the market price or the invoice value only should be considered while arriving at DP. So you should always so periodically you should make it a habit to verify the purchase and sale invoices and cross check them with the stock statement values, right? That is one thing. One more thing you have to keep in mind is the DP actually should be having some relevance to NWC. You will be encountering situations where the NWC will be negative, or otherwise the current ratio will be below 1. Okay, NWC will be negative, but you'll see the company submitting DP that is very sufficient. Okay, this is a situation that doesn't happen in practice. Okay, so DP should be having some relevance to the NWC because at some level they are related. At some level, right? They're not directly related. You cannot establish a direct relation between these two, but they at some level they are related. So if a company is doing bad on one parameter on NWC, it cannot have a significantly higher DP. So this is one thing you need to be careful about. So dues from sister firm should be excluded while arriving at DP. So in the items of stock statement, we have all the raw material, stores and space, work in progress, finished goods. You also have debtors, okay? Because banks extend finance against debtors also. Maybe to a lesser extent, like 50%, not the 75%. A lesser extent, but nevertheless they allow DP against debtors. Now these debtors might include who are debtors. So for a company, debtors are these customers. Okay, customers of the company. So to these customers, the company has sold its goods and it's expecting some money from them. Okay, these goods are sold on credit and debtors arise because the goods are sold on credit. Now the customers are yet to pay the amount and they are expecting the amount that is known as debtors. Okay, against that debtors, banks are extending 50% finance. Now it might be possible that the company has some group firms, sister firms or associate firms, and these debtors value include the sales to the sister company. So it is a pragmatic so usually it's a good practice to exclude dues from sister firms, right? So in certain situations there might be genuine trade transactions, right? These two are independent companies, independent in the sense that though they are group, the sale of one company might be the input to the raw material for other companies. So okay, based on genuine requirements, you can you need not deduct in some cases, but dues from sister companies you need to be very careful. Okay, it's a good practice to exclude. It's a good practice to exclude when arriving at DP. Okay, sometimes what happens is the group firms will be engaged in the same line of activity. They'll have the same types of stocks. It's just that the two companies are different. Company 1, company 2. Only the names are different. They're controlled by the same management, right? Same promoters. They manufacture the same goods, and they're also located in the same premises. Okay, this happens. You will come across this sort of a company. So in that case, you'll be very careful while calculating DP because you should identify the stock separately. The stock should be segregated very clearly. And if these two are two separate bankers, even then you should be even more careful. Okay, so for easy identification, they have to be segregated, right? And when you go for unit inspections to such units, you have to verify that the stocks are clearly segregated. Okay. One more thing you need to be careful while calculating DP is the LC stocks, right? Creditor should be deducted from stocks while arriving at DP. This is a point which we have not yet gone through non-fund limits. Okay, so LC and BG will be discussing chapter 9, right? In chapter 9, there I'll repeat this point. Okay, right? But remember for the moment that while calculating DP, so in DP we said inventory, right? Raw material, work in progress, finished goods and debtors. Okay, so if there are some LC stocks, if this raw material, some of this raw material was purchased through LC, right? This needs to be deducted from the stocks. Okay, while arriving at DP, we deduct the LC stocks. I'll explain this point once again. Next, packing credit. This is an export finance. Okay, so PC stocks, the details should be furnished separately. Okay, and this should be cross-checked with the values mentioned in the export orders. This is for export finance. Now, in the context of drawing power, since drawing power is calculated based on the stock values. Okay, so since so much importance is attached to the stock and the quality and their quantity, both their quality and quantity, right? So a relevant point in this context is stock audit. Okay, so every month the company will be submitting stock statement. So what is the guarantee, right? What is the guarantee that the figures mentioned in the stock statement are true, right? There should be some check. Okay, so every month company, so you will be doing your unit inspections. That is, say once in 3 months or 6 months, you'll be doing that. You'll be visiting the unit and checking the taking stock and checking the stocks. Okay, that is one part. Okay, but every month basically you are relying on the stock statement submitted by the company. So it is possible that the company might not report the true picture. So on various aspects, say for example the quantity which the company is reporting is inflated. Maybe is saying we have got 10 tons. Maybe it's got only 7 tons, right? Or in terms of rate, it might be showing a higher rate. Or what about the quality, right? Some of the stocks might be obsolete, okay, or they are slow moving, okay. Some are damaged. So what is the check on the quality? So these are serious issues, because the whole concept of drawing power is to ensure that the OCC outstanding is backed by tangible security. So right, but if we are giving some fancy figures here and behind there is nothing tangible to back it up, right? So when it comes to liquidating, so when something goes wrong, you'll not be in a position to recover the entire outstanding. Okay, so banks have try to employ a couple of checks, right, to ensure that the reported that the quality of stocks are reasonably good. Okay, so they have their own unit inspections, but apart from that, they employ some independent means of verification. So stock audit is basically, as the name implies, it is an audit. Okay, it is an audit. So besides the monthly stock statements and the periodic unit inspections conducted by themselves, they have a one more approach, that is a stock audit. So they employ external professionals. This is not done by the bank. Okay, stock audit is not done by the bank. It is done by an external professional, usually a chartered accountant. They will employ a chartered accountant, and they will this chartered accountant will go to the unit, right? This is usually done once in a year. Okay, usually once in a year. So this stock auditor will be so this chartered accountant will be going to the premises, factory premises, and he will be independently verifying the stock position. Okay, and the format will be based usually differing from bank to bank, but the major points that they cover basically, so as you might expect, the points he will be covering, the stock audit report will be covering will be the quantity, the value of the stock, okay, drawing power, availability, slow moving and obsolete stock. These are important ones. Okay, so these are the points he'll be trying to mention. It's not just for the stock. Okay, simultaneously he'll be doing for the receivable stocks. That's why we call it a stock and receivables audit. Okay, so it's normal to have a audit both for the stocks and datas commonly. So under datas, what are the points he might be commenting? Say for example, there are some long-standing dues from a particular borrower, okay, that he might be mentioning. Or if one particular debtor is forming a very significant portion of the total debtors, say this customer is a very important customer, he's contributing to 80% or 90% of the sales. So he'll get the list of the debtors, and say the total debtors is 100. This particular customer X is debtors is 75 or 80. There's a huge outstanding from this customer. So those sort of points he'll be mentioning under the debtors. Okay, so he'll be commenting both on the stock and the debtors. Okay, so this is not done for every OCC party. Not for every party, for large borrowers. Say for example, some cutoff will be there. Say borrowers are availing a working capital limit of greater 1 crore or 2 crores, 3 crores. As per the bank policy, there will be a stipulating a cutoff, and in that case, annually they'll be doing the stock audit report again. You as a credit officer, right? When you get the stock audit report, okay, just don't file it. Okay, this is not your job to file it. Okay, you have to put up a review note, right? You have to do a review note. So you have to comment on the findings of the stock audit, and if there are any significant critical points, you need to follow up with the company, right? You have to follow up the company for rectification. Okay. So one more thing in stock audits is when you have a consortium account. Right, when you have a consortium account is an advance where 3 to 4 banks, okay, more than one bank, are joined together to finance the company. Say this is for a huge company, okay. Say for example, the total credit limit is 100 crores. Maybe one bank will take up 20 crores, another 15, another 40. Right, someone like SBI maybe will take a larger share. Okay, another 30. Right, so like that they'll be sharing the total. Okay, so that is a consortium advance. In consortium advance, stock audit is usually done. So in each bank need not employ. Each bank need not employ separately the stock order. Okay, so maybe usually the leader bank will be employing the stock order, and he will be submitting the report. So that will be used by all the banks combined. Okay. So one more thing you need to be aware of when dealing with the drawing power is, so companies will be having some non-fund limits called non-fund limits. Okay. So this will be discussing in detail in chapter 9, right? In chapter 9 we'll be discussing about the letter of credit and bank guarantee. So we will discuss, so for the moment understand that LC is also a credit arrangement. Okay, it is also a credit arrangement. Credit arrangement means the payment will be done later. So say for example you are a company X, you are in India, okay, and there is some foreign suppliers, maybe in Germany, right? There is a foreign supplier Y. So what you do, you want to purchase this raw material, or you want to purchase a machine from this customer, from this supplier who is in abroad, okay. So he'll be, so under LC arrangement what happens is, you will be going to a banker, your banker, okay, and this foreign supplier will also having his banker, okay, Deutsche Bank or some German bank, okay. So LC, this is the modus operandi in bank. This will be discussing in detail later, but this is basically the point. Bank to bank they'll be dealing, okay. In LC the customers won't be dealing directly, okay. It is basically the dealings are between bank to bank, because you don't know who that Y is, okay. He's in some other country, you don't have any contact with him, you're not very comfortable dealing with him, right? You right, you're not very comfortable. So if what happens if you pay the amount as a customer, you pay the amount and he doesn't ship the goods, what you do? That is a problem. Similarly for Y also it's a problem, you know, if he gives you credit, right, if he gives you credit and he ships the material but you don't pay, so what happens? So there are a lot of issues involved here, okay. So there's basically a trust issue. You don't trust the foreign party because you don't know him, okay. So enter the banks, okay. You trust your banker, right? You trust your banker, and he trusts his banker. So basically it will be a bank to bank transaction. This will be dealing, this I will be discussing in chapter 9 separately, but for the moment understand that LC is a credit arrangement, okay. So the goods will be shipped but the amount will be paid later. So it's basically a credit arrangement, okay. So the most important point you have to understand, in LC it is a non-fund limit, right? Unlike a CC, say for example you have a CC account sanctioned to 100 lakhs. What do the company do? The company will draw the amount, okay. Physically cash, he can draw the cash, right, or issue a check. Physically cash is being utilized here. LC is different, okay. LC is a non-fund limit. If you sanction a limit of say 50 lakhs LC limit, company will not be drawing cash. It is not a fund-based facility like a term loan or a OCC, right? These are all fund-based facilities, okay. LC is a non-fund limit. Here you won't be drawing any limit, okay. This is just basically a paper. This is a paper-based limit, just like BG. BG is nothing but it's just a piece of paper, okay. Here no funds are involved, okay. This is a non-fund limit. So you might be tempted when you look at the CMA data, right? When you have all this raw material, machine, land, building, all this tangible asset, home loan, all these are physical funds, okay. So you might be tempted that LC will not appear anywhere because no funds are involved, but that is wrong. Right? That is wrong. LC will have to be reflected somehow. Maybe not directly on the name of LC, but somehow it has to be reflected. The reason being, basically this is a credit arrangement. In a way, creditors are arising here. When the foreign supplier has shipped you goods, right? You received the shipment, and he has given say for example 90 days to pay, right? You receive the shipment and you have started processing this material, okay? But there is 3 months time to pay this company. So basically the creditors are arising here, just like you have purchased raw material from a local supplier. So there also creditors are arising, okay? So you need to ultimately pay this party back. So it is a creditor. So LC, even though it is a non-fund limit, in the form of creditors, it has to be reflected in the balance sheet. So apart from your local raw material suppliers, these creditors should also be reflected. This is fund based. This will anyway be reflected, okay? But this LC creditors should also be reflected in the total creditors, okay? So that is the point you have to be you need to be careful when dealing with creditors, right? So say for example an OCC limit, existing limit is 200, okay? 200 lakhs is the existing limit. So they're also having a LC limit of 100. Now this company has applied for enhancement to 250 lakhs CC limit and 150 in the LC limit. So since LC is a non-fund limit, right, in the CMA data, you know CMA data projections for the next 2 years, 2014-15. These are the projections the company is submitting. So under the short-term borrowing, under the current liabilities, okay, under the CC limit, what they'll do, they'll show a projection of only 250 lakhs because this is the CC limit, okay. So this LC will not come here because it's not a fund-based limit. This is only CC 250. So where this LC will come is, right, under the creditors. Under current liabilities, you also have creditors, right? You also have creditors. Okay, so in that creditors, besides the regular, say for example, the normal creditors in the domestic purchases is 50 lakhs. Okay, 56 lakhs. So apart from those raw material suppliers, indigenous, the LC creditor should also be reflected, right? So since this is 150, so maybe somewhere around 200 or 260. This is around that value. Around that value, it has to be high. You can't just have a local raw material creditors here. Your LC creditor should also be reflected in the creditors. Okay, that is a point you have to be very careful. Okay, that is one. That is one method. Or when you calculating MBBF. So for this company, if you calculate MBBF, you'll get 250, isn't it? If you don't show the LC creditors under creditors, okay, under creditors, if the LC creditors are not reflected, then your MPBF should be 250 plus 150, 400. Okay, I think there's a typo here. Okay, I think there is a typo here. This is not 350. This is 400. Okay, a regular 250 plus 150. This is enhancement. Okay, 150. Okay, so the point is either the LC creditors should be shown in the under the creditors, total creditors, or if this is not happening, then under the MPBF, besides your regular OCC, your LC should also be reflected, right? These are the two things you have to be, right? Why you should be careful about this? Because you should not be over financing the company. Right? If you don't do this, you'll be over financing the company. Remember what we said earlier? Under second method of lending, we arrive at the working capital gap, right? Do you remember how you arrived at working capital gap? So all your current assets minus all current liabilities except bank finance. Okay, this is how we calculate it. So the working capital gap, we said, has to be shared, right? Has to be shared between the NWC and the bank finance, right? So if this working capital gap is say 100, your minimum NWC say is 25, you'll sanction 75. Now if you don't consider the LC creditors here, what will happen? This figure will come down. So your working capital will go high. Say for example, you'll go to 150. Then you'll be sanctioning a higher bank finance, maybe 40 here and maybe 110 here. So like that. So what happens if you don't consider LC creditors, you'll be ending up over financing the company, right? So that you should always ensure that LC creditors are reflected in the total creditors. So with this, we come to the end of the segment. In the next segment, we'll be discussing about a very important concept under working capital assessment, that is diversion of funds. Okay, see you then.